Friends, in this video, I am going to talk to you on the topic, are all ETFs really passive? ETFs are seen as the instrument to do passive investing. If you invest in an ETF, you are expecting that the ETF would deploy the money you give them very comfortably into stocks contained in the underlying index based on which the ETF is constructed. It means that the money you are given the ETF will be invested with a low impact cost and you will continue to own the ETF for a very long time to come. But in reality, are all Indian ETFs really suited to be called passive? Are they qualifying to be called passive? Today we have ETFs in sectors. Some of these sectors are extremely volatile. You have ETFs in every kind of index. You also have indices which are momentum indices. So, calling all ETFs as structurally passive is something that we need to question right now. The trigger for this came because today you have small cap index based ETF, mid cap index based ETF, and as a crowning moment, you have a micro cap index based ETF. Now, what happens when you have indices backed ETFs in these kind of illiquid parts of the market? A lot of money gets gathered, as simple as that. So, when a lot of money gets gathered, the fund manager has to deploy that money the next day. An ETF cannot take a cash call. So, if there is a 25 crore collection in a single day, then the next morning the 25 crore has to be deployed. And if investors see good returns in that ETF, they would give not 25 crores but much more every week. So, the fund manager has to keep on deploying. So, every passing day, they will still buy the stocks whatever price they are. That's what an ETF is supposed to do. So, effectively, flows when aggressively done into a illiquid space where there is an ETF will lead to very high impact cost for investors. And those who come in later pay higher and higher impact cost. So, the ETF would be hardly passive in character. In fact, it will be hyperactive according to me. Now, applying theoretical knowledge can be very dangerous in this kind of situations because you are theoretically told that ETFs are passive and you can be assured that they would be low volatility products. But you can't have a passive low volatility ETF based on a micro cap fund or a small cap fund. It's very difficult to create such a thing and to sustain such a thing and to manage such a thing. Strangely, we are having these and we'll have to live with these kind of products. And these kind of products, when bought during the present phase of the market, when there is too much froth in the market, would be a risk for the investor. Investors would be taking more risk when you buy when the prices are so volatile. The time to probably buy these would be when no one is interested in that entire space, when nobody wants to buy that entire category. Stocks are all going nowhere and stuck in flat price ranges. That would be the best time to bet on such an ETF. But clearly, we are not in such a phase of this market. This market is extremely volatile. So, if you invest in an ETF based on an illiquid part of the market, be it a small cap or a mid cap or a micro cap or some sectoral theme, rest assured that you are being an active investor and the ETF's way of deploying money will make your investing more and more active. And you need to behave and treat that investment not like a passive investment but like an active investment, because you should at times exit these investments when the volatility becomes too high, too much for comfort and too hot to handle. So, there should be a close watch on the investment and there should be a move to safety when it is clearly warranted. So, this is something that investors who are now investing in these high risk ETFs where there is high impact cost must bear in mind. It's something you cannot overlook or overrule. Be conscious and take your investment calls by following some simple principles and sticking to what is good sense of valuation. Thank you for watching this video.